The Dow fell this week while the S&P 500 and the Nasdaq both gained. This as the U.S. economy added another 517,000 jobs in the month of January. The added jobs were much higher than expected, and the unemployment rate dipped to 3.4%, and this is the lowest unemployment rate since May of 1969, and yes, I was around. The stronger than expected report doesn't make anyone on Wall Street feel comfortable that inflation can decline quickly enough for the Federal Reserve to take a step back from raising interest rates. More people working means more people spending money, means more inflation. But will that necessitate more rate hikes? The telltale sign that markets are worried that the federal funds rate needs to keep rising is the 2-year Treasury yield. And the 2-year Treasury yield is up to 4.3% from just below 4.1% a little before the jobs data was released. We'll keep an eye on the 2-year yield because it seems the only thing going higher is that Chinese spy balloon. Two charts today, beginning here with the 2-year weekly chart on the volatility index, and as you can see in the upper left, the symbol is $VIX using stockcharts.com, and we've looked at this a number of times. A very long, wide basing bottom dish here with the trend line in the most recent months moving on up this way, and the top trend line, say, moving sideways somewhere in between that 34 to 36 range for the most part. What we were expecting, a pinch point as the market evolved, but that did not come, and it looks like the VIX has broken to the downside, but very begrudgingly. It's not very strong on the downside, and that's why the stock market's not very strong on the upside. So we got to keep watching this. Moving here into the lower portion of the chart is the MACD. You can see that so slowly the fast line is getting closer to the slow line. You can tell that by the histogram moving up here, just very small increment moves on the way up towards that zero line. So sooner or later, most likely later, the fast line will move up and through that slow line, and we'll just have to gauge to see how strongly it moves on up. Right now, the move on down is very slow. So we'll see what the move on up is, and if the move on up is very slow, then that means the stock market will head down, but very slow. I like faster moves on the up and the downside. It's much easier to pick trends when that happens. Up here in the upper portion is the RSI, the Relative Strength Index, and as you can see, it's just waffling sideways as we go. So not a lot of conviction to the market or to the VIX. So we just keep watching and look at the probabilities, and I would say that the probability is on the upside, but just barely. I'm looking for a turn, a change in that trend, say within the next week or two. So keep your eyes open, and let's now go to our charts. And we're now looking at the 2-year weekly chart on the spiders, the SPY, and the close on Friday, 412.35. Back to the channel line, the bottom trend line moving through like that, more or less. The top trend line moving through like this, more or less. You can see that we popped through the top of that channel line here, moving through the 20 and the 50 EMA, but it's not as strong as one would hope. It still did pop through, but I'm not convinced that we're at the top. Even though last week I was thinking that the probability was a reflection back on down, I was wrong, and as you all know, I'm sure that's the first time that's ever happened. But it still, to me, is not convincing on the upside. One of those reasons is the volume. Volume is not real strong, definitely in the last month or so. Moving here into the MAC. The MAC is moving from this nice bottom and basing, moving on up, just popping through that zero line, with the slow line moving on up to, not quite to the zero line. So there is a bit of acceleration between the fast line there and the slow line here. So we are moving on up, and it is strengthening, but I'd like to see both of these above that zero line to be able to call this a much stronger market in recovery. Here in the histogram, definitely this level here is continuing from that reflection, moving on up. It will probably get to that level here in the next week or two. So definitely extending its strength there. But the price rate of change gives me pause. Some of this sawtoothing up here indicates to me that things are weakening a little bit, with the last sawtooth heading on down. We'll have to wait and see, but I think we're going to at least pause here pretty soon. But I was wrong last week, and I can be wrong this week too. Into the price, or rather the relative strength index. Now, from way back here, we have had a movement strengthening all the way up through here, and that's part of the problem, is that the market has been strengthening, but in very small increments, so it's difficult to really judge how strong the market is at this point. We are above 50, and the strength level is at 66.02, which is only moderate. Moving down here into the stochastics, both the stochastics and the Williams, as you see, are in oversold territory, but they climbed up begrudgingly. It took a while to get on up here. Again, that's kind of giving me pause in calling this a real strong market. Moving back up here to the price chart, one last look here. Again, I'm not quite convinced, even though we have made it through these moving averages and the trend line here. But we got to keep our eye on this, because this is somewhat of a stealth market move to the upside. Many stocks are way behind this index. So keep looking for those stocks that have improving trends, because you can still get into those stocks at relatively decent levels. But my suggestion is that rather than put your money all into one stock at one time, average in. This is the kind of market where I'm not so convinced that this October was the low. It's possible it was the low, and if so, when averaging in, you get a little bit of good prices with some higher prices, but also with a lower risk. And for today, that's ChewDog Charts. Thank you.